If you've ever looked at your bank account and thought, how do people actually get ahead? This channel is for you. I'm a 26-year-old who lives in Australia and I'm just trying to retire by 40. Not by winning the lottery or by moonshotting some crypto. I'm just being smart, consistent, and completely transparent with my money. I'm calling this channel Respawn to Retire, and that's just because I love to play Call of Duty, and every time you feel like you've been financially wiped out, you can simply respawn, start again, and just build something real. Every week, I'll be showing you exactly what I'm buying and how much I'm putting in, and how my portfolio is tracking. I'm not going to sugarcoat anything. I'm going to be completely authentic with you guys. And yeah, I hope that you guys are enjoying the journey with me as well. We're going to start with saving $10,000 though, because saving $10,000 for me was a massive milestone. I've only just recently got there, and I can tell you that the freedom that comes with it is just something I've never really had. Also, having $10,000 saved actually means that I have real movement in the market. Before, I might have invested, $200, $50 here and there in some brokerages that wouldn't take any fees, and I wouldn't see a lot of movement because of such small amounts. So I would get bored and pull it out. And I started to realize that that's not really investing. That's just moving money around. So by saving 10K, that was able to show mom, it was able to show myself that I was able to stay disciplined and delay that gratification. And I just feel that consistency is literally the only skill that matters when it comes to long-term investing. So how did I actually save my first 10K? I'm not going to be generic and just give you a make a budget advice. I am going to tell you what actually worked for me. And look, making a budget was definitely a part of it. But another thing was I had to cut down on unnecessary spending. So, like, I love caffeine, I love coffee, and I had to cut back on it and actually make it myself at home. I had to stop upgrading things that were already fine, buying new chairs for the gaming setup, or just things around the house. I didn't need those anymore. I didn't need to update to the newest phone or latest console straight away, or buy the latest game. I just needed to tell myself that, was this purchase actually going to make my life better, or is it just going to make me feel good for a week or two? And most of it was the second one. Um, the third thing I did was I automated my savings before I even, and I wouldn't say automated as in I set an automated thing. I made sure that I paid myself first. So when the money hit my account, I put the money straight into my savings. And I know that might seem like a simple and obvious thing, but a lot of people, what they do is they get paid and they pay their bills straight away. They're so concerned about what's going out and less concerned about what's coming in. So I wanted to make sure that I was consistently saving it, and I kept a little bit of money on the side to play around with, buying things here and there. At the end of the day, you still need to have a life. But I made sure that if I was going to save something, I wasn't going to touch it. And the savings were going to happen first because that was the mindset that I needed to have. The last thing I had was I treated it like a game. I made a simple tracker on Excel and manually ticking off these goals of reaching $500, $1,000, $2,000, $5,000. This gave me momentum, and momentum was something that I was able to ride until I got to that 10K threshold. And that feeling of crossing over the 10K threshold was incredible. Okay, so we've done it. We're sitting at $10,000. Now what? What's our next step? So I achieved 10K last week, the following Friday, and I've been thinking about where am I going to deploy it. So yesterday I deployed all of it, bar $1,000. I still have $1,000 in cash sitting on the side. So 9 grand has been evenly distributed amongst a variety of ETFs. So I live in Australia, so I've invested in things like NDQ, IVV, IOO. If you're living outside of Australia, you probably don't know what these ETFs are, but I want to give myself diversity. If I'm automatically diversified within these ETFs, if one company tanks, the market barely moves. I'm looking to get a couple of broad market ETFs and also some sector specific ETFs. So I have a good feeling that things like miners, energy, and semiconductors and things like that are probably going to rebound fairly good within the next coming 6 months, if not to a year. I have a good feeling that with the Iran situation at the moment, the price of oil will eventually stabilize. We don't know when that will be, but mining will be able to resume, rare earth metals. The AI tech industry will continue to rise. There might be a little bit of a bubble in certain companies and things like that, but I think largely companies like Anthropic and the demand of having things like chips and semiconductors will continue to be a major play within our economy and within our day-to-day lives. So I think that investing in those things now, holding them for the long run, I know that there will be some up and down periods, but I'm looking to hold it out as a long-term investor. And when I start to feel that maybe the sector is starting to go down, this will either be a good moment to move my money into a new sector or to simply buy more. If I've got a good feeling that that will rebound back and my position is strong, whether it's got good moats or yeah. A lot of my strategy involves in contributing monthly amounts. So my goal is to contribute, and not everyone can do this, but my goal is to contribute $3,000 a month for the next year. Dropping this amount monthly into a variety of ETFs will ensure that my account will continue to go up. I'll be able to average into the market through dollar cost averaging. And when the markets go up or the markets go down, it doesn't matter. My job is to continue to invest and ignore the noise. So here's my summary of what I just told you. Save the 10K. I've just completed it. Don't touch it while you're building it. Cut the sneaky stuff out, like upgrades, lifestyle creep, things you don't even notice. Automate your savings and try to track your savings so that way you can get some momentum. Once you've got it, invest into simple, diversified ETFs. Stop checking it every day. And that's the whole playbook. Well, at least for step one. Next week, I'll tell you how my portfolio is going, how it's looking. I'll give you an idea of the real numbers. And hopefully you enjoy the journey with me. That's us for Respawn and Retire. See you next week. Hey guys, it's Respawn and Retire. Last video we went through my portfolio, what I'm going to be doing with this channel, and how you can take advantage of the current economical climate. In this video, we're going to be going through exactly what my portfolio consists of and how you can copy it and follow us along for the journey. Okay, to get started, I have 1, 2, 3, 4, 5, 6, 7, 8, we'll say 7 different ETFs or companies that I've got in my portfolio so far. I say 7 or 8 because 8 is technically the cash that I have on the side that isn't being used currently. Now, we'll start with the first one, which is NDQ. Now, I should preface that all of these are, in fact, weighted the same. So, all of these are 12.5% evenly distributed amongst throughout the portfolio. So NDQ is my first one. NDQ just tracks the NASDAQ. It is a pure top 100 tech play. This covers anything from Meta, Amazon, Microsoft, Nvidia, anything like that is going to be within that tech play. Now, this has historically had quite good returns. I know you can't base everything off history, but we're looking at the top 100 companies. I believe that this is a good solid start to diversifying the portfolio and hopefully having consistent returns in the future. Currently down a little bit, but rallying back. So there is some room to grow there, and hopefully we can see some gains. Our second holding is IOO. This is going to be the top 100 global ETF. So this gives us a bit of more diversity amongst the world instead of just in the US. The NDQ is just a US based tech play. This is more of a top 100 global cap. And this is going to cover things like Nestle, Samsung, stuff that isn't entirely US based, but gives us a bit more broader, coverage. That way we're not too skewed in just the US or just tech. Our next one is the IVV. So this is the top 500 US companies. So companies like Apple, Microsoft, Nvidia, Amazon. You'll see there will be a little bit of overlap between the companies. I'm not too concerned about that. The reason is because a lot of these ETFs are very low in fees. And look, I might have a bit of double up on some of the companies within the ETFs. Like I've just said, NDQ probably doubles up a lot with IVV, but I'm willing to run that risk personally, and you might have a different strategy in mind. But for me, I'm not too concerned about the overlap. If anything, it might carry it up a bit more. All right, then next we've got QUAL. So Qual, however you like to pronounce it. That's also going to be a 12.5% weight in my portfolio. This one screens the most financially solid companies. So instead of just having a specific tech-based or mining-based ETF, this one more covers. This one has a bit of a screening process. So that way, companies that enter into this ETF have a very good cash flow, very low debt. This one has slightly low volatility compared to the others, but because of that, it offers consistent returns. So we might not see as much growth with this one compared to the others, but we also might not see as much drawback compared to the others when there are, shifts with current economic situations like the Iran war. Moving on to our next one, we have Semi, and this is for the semiconductors. This covers companies like ASML, TSMC, Nvidia again, anything that's going to be chip related. And this is really the backbone of any EVs, data centers, all of the AI stuff that we're seeing at the moment. Semi, I feel like, is a more long-term play at the moment. Obviously, there is quite a big boom in the AI industry, but I feel like maybe it is still early. We've only really had AI for the last 2, maybe 3 years now with the introduction of ChatGPT through OpenAI. I think AI is still got a lot of room left to grow, but it will be very particular companies. You're seeing a lot of companies pivot into them. I did hear a story the other day about some shoe brand that tried to pivot into AI recently, and I think you will see a lot of companies trying to replicate that. But I think the big companies like with Anthropic and Amazon, Nvidia, OpenAI, those companies that are really pushing to put a lot of money into it, there's still a lot of room left to grow and a lot of application that hasn't been applied yet. So we're going to hold that one for long term. I definitely think there will be some volatility in it, but long term, I think we'll see consistent growth. Now, our next one is going to be Wire. Also, once again, 12.5% holding weight, sorry. With Wire, this is more of like our copper miners ETF. So this is going to facilitate growth in the tech and infrastructure and energy industry. It's going to cover all of our mining. A lot of the miners especially in Australia, will have multiple ores they'll mine. So you'll see some that will just be gold and silver and copper. But this will cover for us things like Rio and BHP and etc. that have it gives us a bit more exposure to miners without just having only copper miners. So I think we're going to have this is more of a long-term play again for us. I think we're going to have a lot of choppy sideways action happening with the Iran situation, but I've decided to get in early at a discount. It's definitely dropped off a little bit, pulled forwards ahead recently, but I think it will be probably the most volatile out of any holding I have at the moment, but it also will have the most upside because once things do settle down and mining does continue to go on, I think you'll see a big boom in the industry and we'll be there to catch all the gains, hopefully. Now, our last one is PME. Now, this is a medical company. This isn't actually a ETF. This is the only company that we'll be holding at the moment. PME has a very clear moat. It mainly deals with its medical imaging technology. It is trading well and truly below all-time highs. Mainly because about 6 months ago, it was priced to perfection. It was bringing in so much money, had extremely high revenues. Everyone was definitely assuming that it was going to be doing incredible work, and it still is putting up incredible work. But a few of the reports were not at the absolute perfection that people were pricing it into. So the stock has tumbled quite a bit. At one point, it was down 60% from its all-time highs. However, it's started to rally back now with gaining more contracts in the US. So I think that its previous all-time highs, where it was sitting in around about the mid 300s, from what I believe, it's pulled back to about 140. I want to say off the top of my head. I'm not looking at anything at the moment, but definitely I definitely think it's pulled back a lot more than what it should have, mainly because of what's happening with Iran. We've had a lot of money cycle out. So with the pullback itself that it was having, that on top of this economical situation has had a massive pullback that probably is a bit unjust. So I think that it's going to rebound quite heavily once institutional money returns again and whatever's happening in Iran settles down, and we'll see it return to maybe that like low 200s. I don't think it will go up to the 300s that it was at before, but maybe low 200s, if not higher. Excellent company, great moat, like I said, and definitely one I'll be holding long term. Now, as I said, that we were going to be completely transparent with you guys with where the portfolio is sitting, where it's at, as we go through this journey together. Currently, we are sitting at $8,685. We are down 0.5% at the moment, mainly just due to trying to recoup our brokerage fees. We spent $70 with 7 buyers on this on these brokerage fees, and yeah, we're just trying to recoup those losses at the moment, and so we're sitting virtually flat. We also still have just over $1,000. So we've got about $1,200 in cash at the moment, and yeah, looking to add to it hopefully next week. Going into the month of, well, for the rest of this month, I'll have another buy-in point. I might buy in, if we see another pullback, I might use the cash, or I might just wait another few more weeks. But I am definitely looking to consistently buy into anything that's on a dip. So wire currently, I think, will be the most volatile. There's been a lot of open close noise with the Iran Strait, so we might be able to get a bit more in wire and take advantage of those lower prices, because eventually they will rebound, unless you're betting on the entire mining industry collapsing, which is very unlikely, or things get sorted out and we do get there. It's just about, can I hold out for the long run? The other one we might be looking at potentially is putting more into NDQ. That one is doing quite well, actually. We're currently up 3%. So if we see continuous gains on that, we might top up on that as well. Ones that we won't be looking to top up on at the moment is things like semi or IVV or IIO, just because they're a bit broad and they're trading relatively flat. I like to trade. This is me personally. I like to trade on things or invest in things that are moving, whether it's up and down. At least I know if it's going up, then we might need to buy in and continue to go up. We are looking at more returns. If it's going down, all the better. We will continue to buy up that. If it's trading flat, I don't like to put money into stuff that's trading flat at the moment, just because I'm not sure what's happening with it. Whereas when there's movement, at least I know what's happening. We've got movement up or down. I can make a decision from there. So currently our portfolio sits at about 10,200, just over $10,200, including our cash. So we've got 8,600, as I was saying before, currently invested. We have about 10,200 sitting in cash, or including cash, sorry. And yeah, I'll continue to give you updates on what we do next. and what plays we're looking to invest in. And if there's any developing news, I'll let you know. Hopefully you've enjoyed the video, and that is us, guys. I'll see you on the next one.
I'm invincible. I can't be vinced. I'm invincible. Who's trying to vince me?
All right, so we need to talk about oil and how it's about to affect the entire world, but specifically Australia, because we're in a more vulnerable position than most people realize. The situation is this. The US launched strikes on Iran, which led to the closure of one of the world's most critical oil shipping routes. There's been a lot of back and forth ever since then, and the result of oils have spiked hard. I've seen diesel in my local area hit about $3.50 per litre, and unleaded pushing around $3, and that's not normal. Only just recently, maybe the beginning of the year, we were seeing prices at about the $2 or even $1.80 region for unleaded. Now, Australia is in a uniquely bad position here. Unlike most developed nations, we have almost no domestic refining capacity. We have oil in the ground, there's heaps of it, but through decades of poor government decisions and misaligned energy policy, we've ended up completely dependent on other countries to refine it and sell it back to us. I won't go deep into the politics of that today, I just want to say it's a serious problem that needs serious accountability. Anyway, this channel is about investing, so let's talk about that and how you can actually position yourself to benefit from this situation rather than be a victim of it. Number one, the food and agricultural industry. Food is the lifeblood of any nation, same as energy. We're already seeing upticks in companies like Coles and Woolworths as consumers stockpile and shift spending habits. I definitely think that these are defensive plays, also, as a side note. So we would have seen a lot of institutional money move into these companies when there was the risk of volatility because these companies are so stable. But back to it. These are an interesting play for me because I feel like something like the food ETF, which gives us exposure to seeding and crop production companies globally, will increase massively. The reality is farmers are getting squeezed pretty hard right now. Transport costs are up, machinery costs are up, margins are shrinking. The costs just don't disappear though. They will either get passed down the chain, which usually lands in the consumer. So I think we're going to see a lot of grocery prices increase in the next 3 to 6 months. And those revenue numbers will be reported on at the end of the financial year. I think they're going to tell an interesting story. It's undeniable that the food and oil and transport will all be going up. So within theory, those stock prices should also increase as well alongside of it. And when grocery prices go up, so will stock prices for those companies that are selling them. Number two is oil and energy, as briefly mentioned earlier. Australia has been essentially caught with its pants down on this one. There is a serious momentum behind reopening domestic refineries and reducing our dependence on foreign supply chains. Coupled with the push of tax of overseas miners and Australian resources, I think this creates a real catalyst for energy companies like Ampol, Resilient Energy, and ETFs like Fuel and URNM, as countries, including ours, either double down on oil infrastructure or accelerate into nuclear and alternative energy. Over the next few months, I'll be watching both of these sectors closely. I'm not buying anything just yet. I just want to see that there's evidence that either is actually moving before I commit capital. But if the data starts confirming this thesis, you'll see me add a position and I'll be documenting the whole thing here for you. That's the play as I see it. Let me know what you think in the comments below. Are you watching any of these sectors? If you are, follow along as I make these decisions in real time. Subscribe, and this is Respawn and Retire. See you next week. The ASX mining sector has been absolutely smashed over the last few months. Billions wiped off the market, but here's what nobody's talking about. Some of Australia's best gold and lithium miners are now sitting 25 to 30% below their all-time highs. And my buying period is in 4 days. So today I'm breaking down exactly what miners I'm watching, which ones I think are genuinely undervalued right now, and which ones I think you should actually stay away from despite their massive 250% run. Let's get into it. Alright, I've done a proper deep dive on 4 stocks you should be checking out right now. Here's my honest take. And just a reminder, I'm not a financial advisor, so treat this as research to inform you on your own decisions rather than a recommendation. Let's get started. Alright, first up is NST, Northern Star Resources. This is a genuinely high quality gold miner. NST has maintained its FY26 production guideline of over 1.5 million ounces, reporting an underlying free cash of $301 million for the quarter. The all-time high was $31.96 back in March of 2026, and is currently sitting at $22 to $23 roughly. So that's about a 28% below its peak, which aligns with what we're looking for. We're looking for great companies with heaps of cash that have the potential to rally back. Now, the risk here is cost pressure though. Total capital growth expenditure is projected to rise between 2.3 to 2.4 billion, primarily due to the cost pressures of the flagship KCGM. The bull case though is strong. Central bank buying at a multi-decade high, geopolitical safe haven, and inflation hedging all support sustainable gold strength, NST's biggest external lever. If gold stays elevated and those capital projects deliver, NST has some serious upside. Analysts are predicting the price range between 20 to 35, which is a really large spread, but definitely suggests room on the upper end for a real run. My view, NST is the cleaner of the 2 gold plays I'm about to show you today. Quality assets, solid cash flow, and gold tailwinds are real right now. Next up is EVN, Evolution Mining. Evolution Mining delivered record cash flows and moved to a net cash in March 2026 quarter, which is a massive positive. They've gone from $1.6 billion in net debt to net cash in 2 years. Record underlying EBITDA reached 1.6 billion, up 59%. The 52-week range is $6.42 to $17.75, with all-time highs of $17.75 in March of 2026. Currently around $13 to $14, it's about 25 to 30% below its peak, consistent with that of our previous company, NST. Analyst consensus is that the target price should be around 14.95. which is only 7% above current levels. However, it is still roughly 20 to 30% below all-time range. EVN is arguably the financially cleaner of the gold miner right now, given its net cash position and record results. Less upside than NST potentially, but a lower risk reward too. Between NST and EVN, both are solid. I think I'd be leaning towards NST because of its operational leverage due to the gold price upside it carries. EVN is cleaner financially right now. However, if I was choosing between the two, I would lean towards NST for its higher potential upside given gold's current environment, but EVN is definitely the safer pick. PLS is our third and final stock we're looking to add to the portfolio. The lithium angle is interesting given the current oil crisis we spoke about in our last video, link in bio. The Middle East crisis is linked to the ASX uranium and lithium stocks, which ties directly into a huge concentration of price creep, up 57% quarter on quarter. This company in particular, similar to the last two, is sitting on a ton of cash, $952 million, giving them some serious flexibility to continue to grow in this market. The risk is that lithium holds a high volatility and analyst targets are mixed. 5 buy ratings, 5 hold ratings, and 3 sell ratings with a consensus target nearing $3 suggests the stock may have run ahead of itself from these December lows. The oil crisis narrative does give lithium a short-term tailwind, which could benefit PLS. My view is, though, PLS is even more speculative than NST and EVN. The oil crisis angle makes it interesting, but as an actual investment, it's very high risk given the lithium price volatility. Now, this one we won't be adding to the portfolio, but it's one that's had a great run, and that is Mineral Resources. This one's a complicated one, and I'd be cautious. The 250% run that it's had recently, the stock has nearly quadrupled since April lows of 2025. Now, the concern is that the average broker price now sits at about $60.35, still roughly 4% below current closing levels. The stock is trading at or above where analysts think its fair value is right now after a massive run. New investors like myself probably should stay away from it and wait for a quarterly downturn or perhaps a drop in price before jumping in. In my view, Min is definitely one to watch, but not necessarily one to chase right now. I'm going to wait for a pullback on the quarterly update and confirm the thesis before buying. Bottom line is though, I've got 4 days to decide what I'm going to do with my money, as I want to consistently put it into the market to start working for me. Over the next 4 days, I'm going to sit down and have a look at some ETFs that I'll be bringing to you that might be better alternatives for my money. However, these individual stocks are definitely an interesting and genuinely worth the risk potentially to give us some decent exposure in this sector and a good rally for our money. Let me know what you guys think about the current mining sector. I'd love to hear your thoughts on what you think about those 3 stocks and what you think about minerals. I think it's definitely had its run, but let me know if you think otherwise. Hey guys, welcome back to another episode of Respawn and Retire. Today we're going to be going through the portfolio. I've made some buys. As you can see from the thumbnail, the portfolio has grown. We've put more money into it, and we've also made a little bit of percentage on top. So let's get into it straight away, shall we? So we have deployed a bit more of the capital. So we initially started with $9,000 deployed with 1,000 left over as cash for any opportunities. However, over the past few weeks, I've actually moved just some things around. I just wanted to set the portfolio up a little bit better, and we've deployed another $2,000 in cash to finish out the month of May. The month of April. Now, with the portfolio, a couple of things that we've moved around. Let's go through some of the holdings now. We've still got our NASDAQ. We've actually doubled down on the NASDAQ now. And we've still got our IOO, IVV. We are currently out of the wire though. We've traded out of the wire just because there's just too much going on with the Middle East and the fuel crisis at the moment, and I'm just not really too confident in that play right now. So going through the portfolio, NASDAQ, we've doubled down. That is out now our highest weighted position in the portfolio. So currently we have $2,000 invested in that, and we're sitting at a small return. So our initial investment, we did see 10% return earlier in the week. Then when I bought back in, obviously that's pulled it back down. So now we're sitting at about 5% overall for the position at $2,109. We've still got our IVV, IOO, both up about 4.5% to 5% each. Sitting at about 1,000 up to 1,100 per position. Moving down now, we've got our Qual, QUAL. Now that's sitting relatively flat. So that actually hasn't moved at all. It's traded sideways since the last update. Moving on now, we have our semiconductor ETF, which is our best performer currently at 12.18%. We've made about $128 on that, sitting at about 1,188. Moving on to a couple of new purchases that we haven't spoken about, which is our VGE. This is the Vanguard Emerging Markets ETF, and this really just covers any like the smaller caps or emerging markets in and around Asia and just outside of the US, really. Now, we only got that recently, so it hasn't really moved much, and it's sitting flat at $1,000. Now, a new purchase we do have as well is XMET, and I'm going to go through that. That's our Energy Transition Metals ETF, XMET. I'll be going through that later on in the video about why we purchased that one and what the thought process is. But basically, we're currently sitting at $12,253 in the portfolio, and which is what is that? That is a 2% gain currently on the portfolio, and we've managed to increase it obviously by an extra $2,000 overall from our starting position. Now, let's look at some of the things that we did. Oh, another position I forgot to mention, sorry, is we are back in on URNM. So if you followed the previous video, um, where we talked about miners and where we see the market moving and things like that, I did mention URNM in that video and about how I believe energy will play a major component in the future, especially because a lot of countries are heavily dependent right now, or realizing how dependent they are on other countries for things like oil, energy, and other infrastructure. Um, I think we're going to see a really big push with energy, especially with the uranium. And yeah, we might as well get into why we're setting ourselves up with things like URNM, semi, and so forth. So basically, we're looking at the AI bubble. Now, earlier on in the week, we did see the tech sector report on the big tech companies. So things like Microsoft, Amazon, Apple, Meta, etc. And it was really going to tell us whether or not um, the AI bubble was a bubble, or if this is going to actually generate some money. So the reports were that $66 billion had been pumped into AI, and I think a lot of investors, myself in particular, were keen to see what these reports came back at. Was there a return on investment? Was there an ROI um, on this spending? And as we can see, a lot of these companies definitely reported a lot of positive earnings. Some of them have definitely traded down. However, some have definitely traded up. So I think this shows us as investors or people that are a bit nervous about AI as a market that we shouldn't be too afraid anymore. And AI is here to stay. It is effective. It isn't just a bit of a fad. Um, and it will continue to provide more and more revenue for companies that use it effectively. So this is why I've decided to start thinking about the AI pipeline and what other industries and sectors are benefiting from it. So starting the AI pipeline, the thing that a lot of these companies need is energy. Now, coal, oil, those kind of things, very expensive, and there's a lot of complications around them. Uh, Uranium, on the other hand, nuclear power, a lot cleaner, a lot easier um, to deal with, in my opinion. And a lot of tech companies are definitely favoring that pathway. So putting money into uranium for the energy of this pipeline is crucial. Then moving on to the minerals, all right? The minerals, the rare earth minerals, the things that are going to be used for the actual chips themselves. XMET is the ETF that we've put in for that. The beta shares energy transition metals, sorry. This is going to give us a good coverage for all those rare earth minerals that you see, like Linus Earth and stuff like that. Now, once you've got the minerals, they need to be turned into chips, semiconductors, and things like that, which is why we have the semiconductor ETF now. Um, Now, once we've got the chips, we're going to need some place to store them to actually run to run the actual hardware themselves. So we're going to need places that, well, hopefully, like real estate, like beta. Sorry, not beta. We're going to need places um, like for example, an Australian company like Goodman Group that have a lot of data centers in their portfolio. These guys have a ton of real estate that is holding and housing these massive amounts of data centers, and because companies are going to need warehouses to put this stuff. Okay, from there, within the data centers, within the chips, within the energy, within all this stuff, we're going to need lithium batteries. Okay, lithium batteries, and we're going to get that through the ACDC ETF. Okay, now this is at all-time highs at the moment. We're going to be waiting for a pullback, fingers crossed. And that will tie everything all together. Now, if you look at the pipeline, we've got our energy, which leads into our minerals, which lead into our semiconductors, which lead into the actual warehouse spacing, the infrastructure, which then leads into the batteries, which then ultimately deals with the actual software. Okay, places, companies like Anthropic, companies like Amazon, Google, the companies that will be benefiting off this pipeline, if that makes sense. Now, all these companies that I've just listed have grown immensely in the last year and sitting at a lot of all-time highs. Now, I was a bit cautious on buying in right now because everything is at all-time highs and we should be waiting for a pullback. However, because big tech, we'll call them big tech, has had such positive reporting, I think that this should be an indicator that this momentum isn't going to stop. This is obviously working and it's only going to get better. It's only going to refine. And companies, especially in the higher end of the NASDAQ, are going to continue to be growing their market share. You know what I mean? They're going to be continuing to grow their services in this industry, and those people further down the pipeline that we talked about earlier will continue to be in demand from said companies. So while we are writing this up, we want to make sure that obviously we are heavily skewed right now into tech. However, we aren't just skewed into tech. We're skewed into the AI portion of it. You see, we haven't just gone into the tech market. We're looking at energy. We're looking at mining. We're looking at uh, real estate. We're looking at rare earth minerals. We're looking at semiconductors and tech. And then we're also looking at the tech itself. So we are diversified, so to speak, from a sector point of view, but we are not diversified right now in terms of uh, outside of the AI. Now, in my opinion, that's okay right now, because this is just a temporary thing. As we get more money, we will continue to invest in other areas that are cheap. I am looking very closely at healthcare currently, and as spoken about in previous videos, mining. I'm really just waiting on this oil crisis to be over and to see oil prices drop down so that mining can return to its normal levels. Um, what others? And some of the other sectors I'm definitely looking at as well is the banking sector. Trying to diversify into financials is another area. But yeah, so that's the update on the portfolio now, guys. I hope you've enjoyed. Give me your thoughts on what you think about my AI pipeline, any areas you can see going wrong with it. And I'm always happy to chat with you guys in the comments section. Once again, awesome to see the portfolio now growing to just over $12,000. And we will continue to invest every single month as we are on this journey. Thanks for watching, and please like, share, and subscribe. I'll see you in the next one. Hey guys, welcome back to Respawn and Retire. Today we're going to be going through our 1 month update. So it's been exactly 1 month since we first uploaded, and I just wanted to give you a quick breakdown of where the portfolio is at. So currently we're sitting at about $14,547 in our portfolio. Now, as you can see from the graph in the video, that's broken up into a range of holdings. So let's just go through them quickly because we've done quite well. We've made about 4.31%. I wish it was 14, which is approximately $547. Now, looking at the holdings today, we can see that NDQ is definitely our largest holding. We've got $2,199 and we're up about 9.1%. We've had 2 buy-in opportunities in that, and we're just riding the wave up. Our best performer is our semiconductor ETF. And we've managed to get about 26% on that. And I'm really, really happy with that. It's at an all-time high. A lot of these holdings are all-time highs. And I really hope for a small pullback, but, you know, we're just going to have to take what we can get, really. Next on there is the IOO, which is our global blue chip ETF. We're at about 1,148, 7.3%. A new one we've got is our transition metals, which is XMET. We're up about 9.8%. Then IVV, we're up about 5.5. Qual, we're sitting relatively flat. URA and NM, which is our uranium ETF. We're down a tiny bit, 4.3. I'm not too concerned. That's more of a long-term hold. VGE, we've got about $1,000 in that. We're relatively flat, along with a little bit of cash. So the portfolio is comprised of $1,000 worth of cash. FANG, which we just added only 3 days ago. That's sitting at about $982. And then VGS and PME are down. PME is down 15%. That's actually our worst stock today at the moment. Healthcare is just getting absolutely smashed. And I'm not too concerned about that. I mean, if you look at the financials of PME, it's just crazy. It's just a machine when it comes to generating profit with such low margins. So this is a long-term hold that we're going to be looking at for a while, and I think it will bounce back. It's just going through some stuff with a crazy high PE ratio, but the business itself is still super solid. And then we have one speculative trade with a ARU, which is a rare earth minerals. We're up 9% on that, and it's sitting. I'm not sure why it's saying that it's at $99, but it's sitting at um, just under about 850, I think. Like it's not super big. So that's our current portfolio. I'm really happy with how we've started. Obviously, we started the channel only 1 month ago, and we've had so much going on lately. We've had the Iran fuel crisis. We've had inflation going crazy at the moment. We've had a lot of buying opportunities to jump in on. We've had the largest reporting season ever with big tech, with all the big tech companies going on the same day. We've got semiconductors going crazy, and now we've just had the federal budget get released. So we've had a lot going on. The market's been all over the place. Hopefully things settle down soon, and we can see maybe just some sideways trends for a little bit, just to consolidate and not have such big swings. The portfolio itself is at it was at $10,000. Now we're at 14,500. So I'm very happy with how that's gone over the past month. We're just under $500 in profit at the moment. We still have $1,000 in cash just sitting off to the side that we'll hopefully look to top up on. Now, moving into the next 4 weeks, the next month's worth of buys, the things I'm looking to buy and top up on is definitely NDQ. We're going to continue to buy NDQ. I think the story of what's going on with AI and the results that we got only a couple of weeks ago are just going to be continue to push those stocks up further. So we'll continue to buy an NDQ and IOO. We are going to wait a little bit longer before we start putting money into PME and uranium, just until the conflict is completely gone, and we can see just where the playing pieces, sorry, where the chess pieces are. But I'm definitely going to be watching those stocks there, because I would love to average down. I'm just not too sure how much further I've got to go. We already have positions in URNM and PME, so it's not like we aren't going to catch the swing up. It's just about trying to figure out when the swing up is going to happen, and then hopefully averaging down. Now, only a few days ago, I think it was 2 days ago, we had the federal budget for the Australian federal budget come out, and my immediate thoughts on this was, as a young person, only 26, I was quite shocked at just how bad it was. I thought that the whole budget was going to be designed to help young people get into the market, get into the housing market, and deal with that intergenerational disparity or whatever they were calling it. But it just feels like the federal budget is just more taxes, and not too happy about that, especially with the capital gains tax that they've changed. So the good news is, at least, is that ETFs have now become more valuable, along with stocks that pay fully franked dividends. Obviously, trading is not valuable anymore, or well, is less valuable.
due to the higher tax rate now that we now have the 50% what is that called? Capital gains tax, CGT. Now have the 50% off on that anymore. So ETFs and long-term holds are definitely going to be more valuable. Companies that are paying dividends that are fully franked, so that way you don't have to pay more taxes on it, is definitely going to be more valuable. And superannuation is going to be more valuable because we aren't going to be selling that. The bad news is that when I do eventually sell my core holdings, because remember the goal is to get to $2 million. When I do eventually sell my portfolio to move from growth to dividends, we're going to pay approximately 10 to 15% more taxes, assuming that we haven't changed the code. I mean, fingers crossed that they change some of this. I'm not really a fan of all these extra taxes, and hopefully by the time we are 40, we aren't dealing with this. But yeah, the bad news is that when we do sell everything and move over to more of a dividend holding, we're going to be paying a lot more tax than that. Now, the changes take effect from July 1st, 2027. So we've got about 13 months to continue all of our short-term plans. So as you can see, we actually have a lot of thematic ETFs. So a lot of and we have a few speculative ones as well. And a lot of these, we will be cycling out of. So things like semi, eventually we will cycle out of semi. Eventually we will cycle out of XMET, we'll cycle out of uranium, we'll be cycling out of FANG, we'll be cycling out of a bunch of these. Once I feel the story is over and we'll take our profit and rotate into the next thing. We'll always have our core holdings, IIO, NDQ, IVV, VGE, VGS. We'll always have our core holdings that we'll be holding and we'll continue to stock up on. So we've got about 13 months to continue to use these thematic trades, try and push the portfolio higher, try to continue to run up the growth, and then post July 1st, 2027, we're going to have to come up with a different strategy. We won't know what that is. 13 months is a long time away, and we just never know what the landscape's going to be by then. So just a quick recap, we're up $4,500 as a portfolio. Okay. 13.5 is actually invested. 14.5 is the total portfolio though. This is only our first month. I feel like we've done really well. We're up 4.31%. And yeah, like, share, and subscribe. And I'm looking forward to continue to update you guys as we continue to invest.